Hey everyone, what a week. Stocks are tanking right now, absolutely tanking. Not all of the stocks, but many of the stocks, especially tech-oriented companies, they are tanking right now, and I am purchasing stocks. I like to buy stocks when stocks are on sale. I don't know if I'm timing the market bottom perfectly, but as a long-term dividend stock investor, income-oriented investor, I like to buy value, and I'm going to keep averaging in here. We'll see what happens in the coming months. Personally speaking, I think it's very difficult to fight the Fed, if you will, and I think the Federal Reserve is going to keep increasing interest rates. And I think as that happens, we may see continued volatility ahead. And so personally, as a more conservative investor, is someone who doesn't like to see a lot of ups and downs, as someone who likes to sleep well at night, I have strategies that I have been using to minimize volatility in my own portfolio. I have strategies that I've been using to sleep better at night. Most of you know my number one strategy, and that is focusing on dividend-paying stocks and focusing on the income that they generate. Because the income that is generated from dividend-paying stocks, the world quality, top of class dividend-paying stocks, those types of companies increase dividends, and my passive income increases over time, even when markets are not doing so well. And there has been a number of dividend increases lately. The most recent one that I experienced was from Apple. It was only 4.5%, but that is better than nothing, and it leaves a lot of room for them to increase that dividend in the future. But that's my number one strategy, is literally to buy streams of income, to buy stocks, but not really look at aggregate stock portfolio value, just to look at my stream of income and how it's growing over time. That being said, there are other strategies that I use overall in volatile times to try to sleep better at night and weather the storm. And so today I have a surprising strategy that I want to share. This is one that I didn't think would even become part of my toolkit, but I have a Patreon or a patron over on Patreon named Michelle. Thank you, Michelle. She has been a long-time subscriber here on this channel and has supported this channel since the early days. And Michelle asked me a question. She asked me, Ian, what do you think about bonds? These are savings bonds that are indexed to inflation. These are savings bonds that are provided by the U.S. government. And so I want to go through bonds today. I want to go through EE bonds and other instruments that are offered by the United States Treasury on TreasuryDirect.gov. I want to talk about those types of investments because when Michelle brought this up to me, I was thinking, hey, these types of products don't make sense for me. They just don't, because I'm an income-oriented investor. I need cash flow coming through to pay bills, and these types of instruments can tie up cash for long periods of time. And I was just looking at them, and sometimes for larger portfolios, I realized they may not make as much sense because there's annual limits on how much you can contribute. That being said, I actually came around and after researching them for a few days, I was like, wow, these are some pretty cool products. And so this has been a long introduction, but get ready, everyone, for this is video number one in my series about strategies that I personally use for weathering any storm, financially speaking. Get ready for an exciting video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first thing I want to do is just let you all know to check out the pinned comment below. I have a link there to my Patreon. I have so much going on in Patreon right now. We sold our Bay Area home, and so some of that money is getting redeployed into the stock market. I'm sharing the trades over there on Patreon, and I'm sharing my portfolio at the corner patron tier with patrons as well. I share the percentage allocation to the different positions, how that's evolving over time. Now, please keep in mind on Patreon that the way their system works is if you sign up towards the end of the month, they charge you for the month that you sign up in, and then it gets renewed each subsequent month. So because we're right now near the beginning of the new month, if you're thinking about signing up, just wait for May 1st. You'll be better off that way. Just wait a few more days. That is how Patreon works. I don't have control over that. I'm grateful for everyone's support over there on Patreon. The community is growing. There is so much content over there. Again, I'll link in the pinned comment below. And so what I want to do is talk about bonds today, and I want to share a lot of thoughts. So check it out on the screen right now. And so the first thing I want to do is just go over the overall strategy and how I'm using I bonds and EE bonds. I'm going to go into so much depth on this today. Obviously, the stock market is tanking. This is the first video in my series about these types of strategies I'm using to buffer my portfolio during the storm, which I think is going to get a lot worse. And while many investors may be fine just weathering the storm just with 100% equities and with wild swings and with 100% tech stocks, some just don't like watching portfolios oscillate so much. I fall into that bucket. I'll tell you, as I've gotten older as an investor, I'm in my 40s now, I do not like seeing volatility. I always try to look at dividend income, and I try to focus on dividend income and the fact that my income is going up over time, but I do have an eye on portfolio value from time to time as well, and I don't like wild fluctuations, and I don't like putting up with it the way that I did when I was younger. And so some people are saying that bonds are dead because interest rates are so low and they're probably only headed up from here given how high inflation is. And I think that statement is a misnomer, so I would be careful. Bond mutual funds may be facing tough times ahead, and they may be a little bit dead if you're kind of invested in bond mutual funds and you're looking for short-term gains or that type of thing, because yeah, when interest rates go up, the value of those bonds go down, and so those mutual funds can have some wild swings. They could lose some value. But if you're actually buying bonds and then you're just holding them through maturity, I still think they have a place potentially in a very conservative portfolio where you want to buffer a potential storm. And so that is something worth noting, that maybe bond mutual funds, and I don't think they're dead either, but I would say a lot of folks are very skeptical of them right now. I am not so skeptical of bonds that are purchased directly from the government or directly from a corporation through an exchange and are held through maturity. And so in particular, right now, there's two types of bonds that I'm looking at, and those are savings bonds. These are 30-year bonds offered by the U.S. government on TreasuryDirect.gov. Now, if you're an international subscriber, please hang in there, because I do believe the value in the portfolio, or the value in the video today about portfolio management, could be beneficial to you as well. And if you are an international subscriber, please put in the comments below. I'd love to know if your country offers these types of products as well, and if they don't, how you look at bonds, stocks and bonds, and asset allocation in your portfolio. And by the way, at the end of the video today, I am going to go through a spreadsheet as well, so hang in there. There's a lot of good content ahead. All right, as you can see on the screen in front of you right now, the thing I want to talk about today specifically is buying these bonds directly from the government and holding them for long periods of time. That's what I'm doing, at least with I bonds and EE bonds. I actually already purchased my first EE bond, and I'm purchasing my first I bond on Monday. I waited for Monday for a reason, and as you can see on the screen right now in front of you, let's talk about that. I bonds are designed to protect savings against inflation. Right now, the I bonds that are being issued by the U.S. government have a fixed rate component and an inflation component. The fixed component is actually at 0% now, but if you bought I bonds decades ago, that fixed kind of interest rate was higher than 0. But the inflation component right now is pretty high because it's 2 times the semi-annual CPI, and CPI is expected to basically, the inflation rate is expected to be about 9.62% in the calculation that is going to affect the I bonds that are issued starting Monday, May 2nd. And that's why I'm waiting for Monday to purchase my I bond. Now, what's worth mentioning these I bonds readjust the interest rate every 6 months, so it's going to get readjusted. If inflation goes up, the interest rate will be higher. If inflation goes down, it will be lower. The key thing here, though, is inflation is so high that there is nothing really more secure, or very few things more secure, than investing in bonds that are protected by the U.S. government, because I do not believe the U.S. government will default on these savings bonds. And so sometimes we think, hey, to achieve like a 9.62% return, you have to buy something like stable coins, which I talk about on my crypto channel. Those carry risk. Now, worth noting, I have not updated my crypto channel for a while. The reason for that is we're in the middle of our move. It's a lot of work. I will get back to it. I thank you all for your patience over there, but I'm still invested in crypto. I'm still stacking crypto. I haven't sold any crypto. I'm still interested in crypto. It's just this channel here is my priority with my limited time. But a lot of people think they have to go to stable coins for interest rate like this. They have to go to a covered call ETF like XYLD, which I also own, which does carry risk. But no, you can now get this type of interest rate on a government-backed bond, which is a really cool. And yes, that interest rate may not always be that high. It's going to adjust. But I think this inflation is going to be with us for a while. And when you can buy an I bond at this kind of interest rate, if you have fixed expenses in your life, like a mortgage, which is probably at a much lower interest rate than 9+%, there's some arbitrage opportunity there that's somewhat risk-free in my personal opinion, because it's backed by the United States government. And if the US government starts defaulting on savings bonds, we got much bigger problems to worry about. And so as you can see on the screen in front of you right now, I want to share with you some more facts. The purchase limits right now for I bonds are $10,000 a year annually from an electronic standpoint on the TreasuryDirect.gov website. But you can also get 5,000 paper bonds per year. The way the paper bonds work is if you withhold too much money for your federal tax return, you can go ahead and ask the government, instead of refunding you in dollars, to refund you up to $5,000 in these paper I bonds per year. And so that gives me some food for thought to overpay on taxes a little bit, because that could bump up the limit to $15,000 a year. Now, you can also get creative about this. My understanding is for a married couple, you can each purchase 10,000 of these I bonds. And if you have a trust, you can buy 10,000 in the trust. If you have a business, my understanding on TreasuryDirect.gov, it allows businesses, partnerships, LLCs to purchase the bonds. And so it's possible to have a family who also happens to own a business have more than 10,000 per year exposure and purchase power on these I bonds. But what I would say, maybe it's not great for larger portfolios, but it can add up if purchased annually and throughout potentially different entities. And that's kind of how I'm looking at it right now personally, as someone whose portfolio is growing. It's starting to get bigger. Buying I bonds 1 year, one and done, in the scheme of things, it's nice, but it's not going to really move the needle one way or another at the stage I'm at now. But what I'm planning to do for myself and my family is to be adding to these I bonds on a regular basis annually for the coming years. And right now I'm just going to earmark the money, set it aside, which further protects it from market downside, because it'll kind of sit around either in cash or treasuries, shorter term Treasury Notes, which I'll get to in a minute, until the time kind of clock ticks off and it's a new year and I can buy more I bonds. And so that's something to keep in mind. Now, I want to go into another topic today, which is EE bonds. By the way, before we go on, if you enjoy this video so far, I know it's a little different. I know it's a little different than my typical video here on this channel. Please go ahead and smash the like button. Don't worry, in the rest of this series, I'm going to cover topics other than bonds, but I wanted to start with this one because Michelle really brought up this topic and it opened my eyes to something new. And sometimes, we talk about dividend stocks so much. Let's look at something different. Speaking of something different, I bought Google Alphabet stock this week, ticker GOOGL, the voting shares. That's something different for me as well. And kind of how do I de-risk something like that? Well, I de-risk it with the I bonds. And so anyway, don't forget to subscribe as well. I really appreciate that. It means the world to me, with that notification bell, so you always know when new videos are on the way. Finally, because we're mostly through the move, I'm back on a better cadence of videos, and I appreciate all of you hanging in there. I want to see if I can reach 100,000 subscribers. So please don't forget to subscribe. One day I'll get there. I'll get my silver play button. That is the goal. Now with that, as you can see in front of you right now, I want to talk about EE bonds. These are also savings bonds. The interest rate on these bonds right now is 0.1% annually, which is nothing. But if these bonds are held for 20 years, the government will basically step it up and double your money. It's part of the deal. And so for someone like myself who has a long-term time horizon, I'll be in my 60s in 20 years. I'll have a low-risk investment here that doubled my money. And basically what that equates to over 20 years, if I run my calculations, is about 3.53% per year. You can purchase up to $10,000 per year. And again, you may be able to purchase more if you're married or if you have a business that you want to set up different accounts for the Treasury Direct. Maybe one for your business and one for your personal or your family account. And so there are ways to get exposure to even more than $10,000 per year. Now, 3.53%, that may not sound like a lot to you, but the way I look at it again is the purpose of the video today, the purpose of these strategies is de-risking volatility in an overall financial portfolio for someone that doesn't want to see wild fluctuations in the portfolio. And also the way I look at it is EE bonds may not make as much sense for someone who doesn't have a lot of fixed expenses. But if you have fixed expenses like me, and if you have a mortgage interest rate which is less than 3.53%, which is like a 30-year fixed mortgage, for example, there's still arbitrage there, getting a higher interest rate on the EE bonds and keeping money somewhat liquid as well. And personally, the way I'm looking at it as well is EE bonds plus I bonds as a blended strategy kind of gets the average person up to $20,000 a year that they could be putting into these types of instruments if they have larger portfolios, and that makes sense for them. And so these are the two bonds I'm looking at, and I already said for this year I bought my EE bond allocation. I'm going to be buying my I bond allocation on Monday, and then I'm going to wait until 2023 next year, and I'll be purchasing more. And so with that, I have more knowledge to share. As you can see on the screen right now, what I want to do next is just go through a hypothetical. What if you have a larger portfolio and that's just not enough? Because with stocks, theoretically, you can deploy an unlimited amount of money, and that's what's so cool about dividend stocks. But what if you want a bigger component in these types of bond instruments? Well, I was looking on TreasuryDirect.gov, and you can buy all kinds of other products such as Treasury Notes. You can buy Treasury bills. You can buy all kinds of different bonds, notes, bills, tips, FRNs, all different types of instruments. But what was really cool, especially with Treasury Notes, which are kind of intermediate term bonds, they're not long bond, they're not kind of short duration either, is for the 2-year, 3-year, 5-year, and 7-year range, I'm seeing yields right now, interest rates in that 2.2 to 2.8% annualized range. And these are determined at auction. And you're not really bidding competitively in an auction when you buy there, you're kind of getting the rate they give you. But that's where the rates are coming out right now on TreasuryDirect.gov. And so what you could do if you have more money you want to deploy is to buy these Treasury Notes, for example. And that's something I've been thinking about as well, because you can ladder them a bit with different maturity dates. And the key kind of hack, actually, that I've been thinking about is this. The core strategy on the bonds for me is really, right now, I bonds, EE bonds, but I can only put in so much to those per year. But what if I want to set aside more and then in future years put in more? Well, while I'm waiting for that next year to come, on TreasuryDirect.gov, you can buy notes, or you could buy Treasury bills. You can buy shorter duration products to kind of span the gap while still earning some interest, some extra money along the way. And so it's better than just letting it sit in cash, earning nothing while the investor is waiting to deploy that money. And with that, I want to show you on the screen right now. Here's a screenshot actually from Treasury Direct website, and what's so cool there, I clicked the Notes tab, and you can see the different securities: 7 years, 5 years, 2 years, 10 years, 3 years, so on and so forth. And you can see these are different issue dates. These are some of the recent auctions, and you can see the interest rates on those. So you can see kind of the range I'm speaking about, and you can see the ones issued more recently have higher interest rates because the interest rates are going up. They're going up fast. Look how much higher the interest rates are just since January, and you start wondering, why is the stock market tanking? This picture can really speak 1,000 words, if you will, because you just look from the bottom of the screen towards the top. Who knows? Maybe you don't even care about bonds at all, but you're wondering, why is the market tanking? Well, the market's tanking because you see what's happening with interest rates. And with interest rates going up so much, it's more difficult for companies to service debt, more difficult for companies to borrow money, more difficult for consumers to borrow money. The consumers can't borrow as much money. They start getting more conservative with their money. They don't buy as much. They don't lever themselves as much. You can see the ramifications that would have on the economy. But from the flip side, if you're a conservative long-term investor, and you've been thinking about adding a little fixed income to your portfolio to weather any kind of volatility, well, this is it. This is interesting to see interest rates kind of come up in this mid to high 2% range for some of these. I think kind of the sweet spot is really these notes. And in particular, when I look at it, I'm seeing like the 5-year and 7-year notes kind of have a sweet spot. But even for someone looking to just park money for 2 years, there's some really nice yields, some interest rates coming through on these types of notes. And on that topic, I'm going to do a video on this at some point, but you kind of start thinking about related strategies, and you start thinking about this. What if you inherit a lot of money all of a sudden? Or what if you sell your home and you get a good amount of money? What if you work at a company and all of a sudden it goes public and you get a lot of the money? One investing strategy is to take all that money and just put it in dividend stocks, one and done, be done, live off of the dividends forever and be happy. And honestly, there's a lot of goodness with a strategy like that, I think, as long as the right dividend stocks are chosen. But what if you're kind of risk averse like myself and you don't want to put in all the money at once because you're concerned the market could tank even further? Well, from a dollar cost averaging standpoint, I think treasuries are the investor's friend, because the investor could put money in treasury notes and ladder them, stagger them, so that when they mature, the money could then be dollar cost averaged into the stock market. But the investor is somewhere to park that money that's reasonably risk-free in the short run, because it is backed by the U.S. government, which is a obviously very strong superpower within our world. And so again, though, if you have a non-U.S. centric approach, if you're a international investor here in the community, please share in the comments below your experience as well with bonds in your country. I'd love to know some of those different international insights. I always love those. I want to keep going, though. As you can see on the screen in front of you right now, the next thing that I want to do today is I want to talk about strategy. And I've already gone through this a little bit, but again, I want to highlight that if you have a fixed expense like a mortgage, and the interest rate is low, meaning you have the mortgage and you locked it like in 2020 or 2021 or earlier this year, and the interest rate was, say, less than 3.5%, it could make sense for a very conservative investor who doesn't feel good about putting too much money at risk in the market. There's a positive arbitrage opportunity between the mortgage and the EE bond even at this point. And so that's just one potential strategy that I've been playing around with. And in particular, I'm not thinking about doing anything crazy or taking more equity out of the home or anything like that, but it just gets me thinking, if I have money coming in, and that money is going to go all different types of places. Some of it's going to go to the mortgage. Some of it's going to go to life insurance. Some of it's going to go just to an account that we're saving to go on a fancy vacation. Some of it's going to go to dividend stocks. Some of it's going to go to retirement accounts. You have a financial portfolio. Well, the part of that portfolio that would have otherwise gone down to like paying down a mortgage kind of early, for me, if that mortgage interest rate is, say, at 3% or maybe even lower, why wouldn't it make sense to go instead and take that same money and put it in some of these savings bonds that are earning a higher interest rate? I see value there. I see arbitrage there. That's all I'm saying. And so as you can see in front of you on the screen right now, I have some more notes. This is for U.S.-based investors, but these I bonds, EE bonds, they're exempt from state income tax, but not federal income tax. What's cool about them is you can defer taxes until they mature or until the bonds are cashed, so you don't really have to worry about taxes year to year. You can pay taxes year to year if you want, but most investors on these types of things just defer it till they mature. They can be redeemed after 12 months, so your money is locked up for 12 months. Keep that in mind. The term of the bond I purchased, the EE bond, was like 30 years. So, but after 12 months, you can redeem them, to my understanding. If you redeem them, though, before 5 years, you forfeit 3 months of interest. Not too bad. You can buy them on TreasuryDirect. I found that TreasuryDirect is really neat. I've had a lot of fun with it. It's easy to use. It even allows you to schedule future purchases and repeat purchases. Those are more at the Treasury bonds and notes and bills. Not as much. I'm not sure if it had that functionality with these savings bonds or not, but there's some really cool bells and whistles over there on TreasuryDirect. And this is totally when you know I'm a conservative investor, when I'm kind of nerding out on savings bonds. Boy, I didn't know I'd ever go here, but this is what happens when you get older, everyone, for all the younger investors here on the channel. There's tons of bonds to choose from, as I've already talked about. And again, I think a little hack is it could be a great way to earn some extra interest just on business reserves that have to even stay with the business. I know a lot of folks out there who watch the channel, they're business owners like myself. I'm a business owner. And sometimes when you have a business in your account, you just have to have extra reserves for a rainy day. And so you really can't afford, though, to put those reserves at risk, in any kind of risk, and the bank isn't paying anything. And so one opportunity potentially is to consider opening an account on the TreasuryDirect website and getting some of those business reserves either into like shorter term paper or even notes, even long bond, and even the savings bonds, and just kind of staggering them over time. That could be a way to get some kind of yield on business reserves. And look, every dollar counts. This is something I put on my Twitter today. Check out the pinned comment below. To find me on Twitter. I have an active Twitter where I'm sharing a lot of insights, but I am a firm believer that in a down market, it's time to kind of hunker down and save money. It's also time to hustle a little bit, earn extra money. And I found, hey, even if I can earn an extra $100 on a Treasury note, that $100 is $100 I can put into one of my favorite dividend stocks like Apple, which I actually purchased a bunch of recently. And so that's just something to keep in mind, everyone, that every dollar counts. Even after having done this for 20 plus years, I'm still of that mentality that if I can save or earn an extra $100 or even $50 here or there, I will get that into dividend stocks one way or another. And that is the mentality I think I'm going to have right now this year, because I see volatility, more of it ahead. Now, with that, I have a fun spreadsheet that I want to share with all of you. By the way, I'm going to link to that in the pinned comment. All I ask is you smash that like button, you get my free spreadsheet. There's no payment for it. There's no sign up for anything for it. There's none of that. Just check out the link in the pinned comment below. Just please smash the like button if you appreciate the content and the spreadsheets here. But as you can see on the screen in front of you, I think this is the most exciting part of the video, because now that you know what these bonds are, you can see what can they really do for you. So I run a bunch of scenarios here. First and foremost, at the top, I show different market scenarios where, hey, the market drops 50%, it drops 40%, it drops 30%. Those are the three scenarios. Those are the three broad columns in this spreadsheet. And what I'm trying to say is most investors, market drops 10 or 20%. I don't care. Well, I care, but what I'm saying is if the market were to fall 50% at my age, that's the type of volatility where even though I know my dividend income more or less is locked in and still growing, if the market's down 50%, am I going to lose a little sleep? Maybe not, but still, it gets to me. These are the types of scenarios where bonds can help. I'm averaging out the I bond and EE bonds, assuming equal distribution to both. So I'm assuming on average an interest rate of about 6.6% per year, but that will go down over time as inflation lowers. But right now I'm starting with 6.6% or so. And what you see then in each column is I have a few different portfolios. I have a portfolio that's 90% stocks, 10% bonds, 80% stocks, 20% bonds, 70% stocks, 30% bonds, and even a 60-40, which is pretty darn conservative, too conservative for me. For me, I'm probably going to end up being more of like a 90-10 kind of person, where over the long periods of time when I start deploying money into bonds and bond-like instruments, there's other ones I've got like stable coins and you know, it carries risk, but it's a cash, intermediate term cash alternatives. I've talked about covered call ETFs. I'm more of a 90-10 kind of person, but there's people here who might be 60-40. But you can see, even with the 90-10 portfolio, if the market drops 50%, I'm only down 44%. In the 80-20, if the market drops 50%, I'm only down 39%. In the 70-30, if the market drops 50%, I'm only down 33%. And so you can see how that really helps. And you see the same kind of results with a 40% drop or a 30% drop. I think a 50% market correction or 40% are probably not going to happen. Could we see a 30% market correction? Yes. So let's go to the last column. If the market drops 30% with a 90-10 portfolio with these I bonds and EE bonds in the 10% portion of it, I would only be down 26%. If the market drops, if I have a 80-20 allocation and the market drops 30%, I'm only down 23%, so on and so forth. The purpose of this spreadsheet is to communicate how the bonds can provide a buffer, and they provide a buffer two different ways. One, your principal, as long as you hold to maturity, it's not going away. But where they also provide a buffer is because of the interest rate, because they're growing in value, they're going to grow in value even when the stock market is tanking. And again, this isn't the same as like a bond fund or something like that that can oscillate in price a lot. This is buying bonds directly and then holding them through maturity. And so, yeah, let me know in the comments below, everyone, what you think. Are you buying I bonds? Are you buying EE bonds? Do you see those as having a place in your portfolio? I didn't think I would reach this point, but I'm becoming more conservative. I think as you get older, and I also think as your portfolio grows bigger, it's easier to be more conservative the way I am these days. And anyway, please go ahead and smash the like button. If you enjoyed the video, please go ahead and subscribe as well. It means the world to me. Those subscriptions really matter. I want to thank you for watching. In terms of full disclosure, today's video is not investment advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, bond market, crypto market, anywhere else, please consult your licensed financial advisor first. It's possible to lose money investing in stocks and other places. We are seeing that in real time right now. And so I'm just sharing my journey here on YouTube for fun and entertainment. It's just my journey. In terms of full disclosure, I am long EE bonds. I am going to be long I bonds on Monday. I'm long Alphabet, ticker GOOGL. I'm long Apple, ticker AAPL as well. And I might have mentioned another stock. If I did, I'm long that stock as well. I've got quite a few holdings that I own. And all right, everyone, I will see you in the next video, and I'm going to see you in the comments section below. I love you all. I hope you have a wonderful weekend ahead. Hey everyone, Ian here again. I want to do a quick impromptu addendum to the video today. I just got off of a live stream with my friend Jose. You may know him as the IPO nerd. He used to actually go by Rico Suave Investing. Jose is one of my favorite YouTubers, and he just did a very touching live stream memorial for one of the YouTubers who I have always been a huge fan of, who unfortunately passed recently. When I heard the news just last week, I heard it on Twitter actually via the IPO nerd. I heard that Marie, she's also known as Minds in Motion. She had a YouTube channel, or I guess she still has a YouTube channel, even though she's passed. Her YouTube channel will live on forever. I'm going to link to it in the pinned comment below from today's video. A lot of you may remember that Marie, Minds in Motion, she was a huge supporter of my channel here on PPCE, and in the early days. She watched and commentated on almost every single video. Her comments were always very heartfelt. She was a big supporter. As many of you know out there in the YouTube community, especially as creators, it's not always easy. When you're trying to get a YouTube channel off of the ground, it can be difficult, and it's that camaraderie and that support from your fellow creators that really means a lot. And I always appreciated Marie's comments because she went into depth. You could tell she really took to heart my videos and took the time to watch them, even though she was actively building her own streams of passive income and her own channel at the same time. And so when I heard of her passing, last week on Twitter, again, from my friend Jose from IPO Nerd, it really hit me hard. And so I was just shocked and honestly very devastated. I heard the news and I was instantly in tears, and for quite some time. And so, Marie, I just pray that you are in a better place right now. I know that you are, and that you're up in heaven with our Heavenly Father, watching over the investing community here worldwide. All of us dividend investors here. I know you're up there doing your finances up in heaven, and we really miss you, Marie. And for the time being, we will continue until we meet again, watching your videos, watching your channel, and enjoying your videos. And so, folks, if you've been here a long time and you remember Marie, please put in the comments below, put in some memories you may have of Marie, Minds in Motion Investing. She had a really wonderful channel, or her channel is still there, and so she has a video content library that will live on forever. Please share that here in the comments. And I just wanted to thank Jose again for doing that touching live stream. It was helpful for me to experience that live stream because, again, this news hit me pretty hard. It hit very hard this week. It was very sad. And I'll just tell you again, I cannot express my gratitude enough for having known Marie and for her being one of the original supporters of this channel. It's not easy to do what the content creators here on YouTube do, and thanks to Marie, I kept going. You know, is those helpful comments, that helpful words that she would always pass along to me. And I am also proud to be a subscriber of her channel, and I miss you, Marie, dearly. And we're praying for your family. We know that, to my understanding, you left behind a daughter. We pray for your family, your husband, your daughter, your entire extended family, for their prosperity. And we miss you, Marie. We love you, Marie. And God bless you.